Hi everybody, it's AJ speaking. This video is not trading advice. I'm just sharing my view of NIO. NIO is a stock that rallied over 30% just in the last 5 days, and currently in pre-market trading is up another 5%. And I believe it's currently in a significant bubble and therefore exposes investors to enormous risk. Again, it's not trading advice, but I would highly recommend to sell the stock now. In this video, I will explain in detail why. So first of all, let's look at actual sales of NIO. So these are all reported numbers, and you can see in July, NIO sold 21,000 vehicles, and there was a sequential decline of 12% from almost 25,000 vehicles in June. This by itself is not a major surprise because often in the first months of a quarter there is a decline after the typical end of quarter sales push. This chart then shows you the same number reported sales on a trailing 12 months basis, so simply adding up as of each month the last 3 months, including that month. So the latest trailing 3 months metric is for the sum of July, June and May. And that reported number was 69,200 vehicles. And you can see that actually implies a slight decline months over months from 72,100 vehicles. And thus far in 2025, NIO sold 135,000 vehicles. Although this doesn't look too concerning, the problem is that NIO put out a volume target for 2025 of doubling sales, and last year NIO sold 222,000 vehicles, which would imply NIO aims for, or told investors, they would be selling 444,000 vehicles. But the issue is after 7 months, we are only at 135,000 vehicles. Yes, in the second half, the Chinese market is always the strongest, and NIO just launched new vehicles, but to reach that, I would call lofty target, NIO would have to deliver enormous vehicle sales growth. And that's why let's look at the very latest numbers that we have available. So these numbers are 6 days old, published on August 19th. Today is August 25. And the numbers were for the week ending August 17. And you can see here the trailing 12-week sales rate of the leading Chinese brands in China. And this chart shows everything in the NEF segment. So not only fully electric, but also hybrid electric vehicle sales. BYD number 1, Tesla number 2, etc. But this video is not about the competition. So let's look at NVIDIA's NIO's sales. And you can see the 3 brands, NIO, Onvo and Firefly combined, generated 66,300 vehicle sales over the last 12 weeks. So all these brands combined. You can see a positive trend in the Onvo brand, and you can see a negative declining trend in the NIO brand, and you can see stagnation in the Firefly brand. And this is basically as of mid-August. So there is not a massive increase. So mid-August means there are only 4.5 months left in the year to meet that sales target. So very simplistically, what you can do, let's put this here. Let me see where I can do it. Okay, here. So 440,000 is the full year sales target. We have 135,000 units after 7 months. So we need this minus that. So we need 309,000 units for the remaining 5 months. So that means an average sales rate of monthly 62,000 units. But if we go back to the monthly perspective, the all-time record high in the super strong December months, that is always very strong in China, NIO only delivered 31,000 vehicles. And when you listen to latest August commentary by management, they also don't talk about this high sales rate. So the bottom line is, first key observation, NIO cannot deliver its lofty sales target, not nearly. And I think we will see later this year what we also have seen in prior years. NIO CEO will come out, we will be very humble and apologize. They couldn't quite meet the target, but they were trying really hard. And they will be taking down the sales target. I believe he will do this after he secured funding, which he will be doing on strong upcoming sales months. So this is the first set of bad news. But there is more. Now we look at an optimistic outlook I shared with subscriber a couple of months ago, and I have not updated that one. And you can see it, the July number, which we by now already know. I have in my forecast highly optimistically at 88,800 vehicles for a trailing 3 months. But we now know this number only came in at 69,200, so significantly below my highly optimistic forecast, which at the time, as I explained, I did on purpose. And the reason why I did it on purpose will be very clear in a moment. But before we move on, just let's look at this forecast. And first of all, as of July, this is significantly ahead of what NIO actually delivered, what we already know. And also August is almost in the books. My forecast is at 102,000 units at the end of August for the trailing 3 months at that point. But when we look at the very latest numbers as of mid-August for the last 12 weeks, the combined brands came only in at 66,000. So there's already, which we know, a huge discrepancy between my forecast and what has actually been delivered thus far. So you might stop the video now and move on and say, okay, AJ's forecast is completely ludicrous. What's the point of all of this? I will get to the point in a moment and what the key insight is of all of that. But the key point for you to take away is that the forecast is dramatically ahead of what has thus far been delivered. And also when you look at the upcoming months and the trailing 12-month sales rate, trailing 3-month sales rate, the forecast is highly, highly optimistic. So for example, in September, the trailing 3 months in my forecast is at just under 116,000 units, and the trailing 3 months as of September, that's the last month of that quarter, and then obviously coincides with the quarter total. So my forecast expects 116,000 sales that quarter, which would be an enormous increase from where we are right now. And because July was significantly below expectation, August is still not great, especially not compared to my forecast. We already know this is completely unachievable. But then for the fourth quarter, my forecast still reflects significant improvement to 145,000 vehicles. And so even if miraculously NIO could actually deliver these incredible numbers that I have still in my forecast, the total for the full year would still be only 375,000 vehicles, and thus significantly below the guidance NIO gave out at the beginning of the year. So for this reason, we as investors can already conclude NIO will be taking down its guidance. That's basically a certainty at this point, or they will just not be talking about it anymore. But now you also might say, oh, so what? Okay, they put out too aggressive guidance, they didn't meet it, let's move on, business is doing great otherwise. You might be too quick in this sort of assertion. So let's move on, because what this actually means. And for that, let's look at the revenue outlook, and keep in mind the revenue outlook you're looking at is based on NIO achieving these what I believe unachievable sales that you just looked at in my forecast. And I think we concluded NIO is highly unlikely to get close to these numbers. So you already look at highly, highly unrealistic, almost revenue outlook. So what do we see? So my forecast expects for the third quarter, 23% year-on-year increase, 45% increase in the fourth quarter, so it looks great. And in only in 1 week, we will get NIO's second quarter numbers. I actually forecast 11% decrease. So we will have to see what's going to happen when investors wake up and realize, oh, NIO, yes, significant volume growth, but revenue is declining year over year. But let's move on. So the bottom line is, forecast you're looking at is revenue that will not be delivered this year by NIO for sure, because they cannot deliver the volume that we just looked at. Then we just look at the volume underlying this revenue forecast on a monthly basis. We already looked at the trailing 3 months numbers, but here you can see again in July, forecast reflected almost 41,000 vehicles. NIO came in at only 21,000 vehicles. Here, quick reminder, these are the reported numbers, so July reported 21,000 vehicles. And in case you don't believe me, let's look at NIO's monthly sales disclosure. Here, 21,000 vehicles were delivered in July 2025. For a total of year-to-date 135,000 vehicles. This is what you see in this chart down here, 135,000 vehicles. By the way, before we move on, and I also posted this to my subscribers and warned them this was a red flag, NIO slightly changed its sales disclosure. Most people probably didn't even recognize. NIO removed from its monthly disclosure the year-on-year comparison because it didn't look favorably. So here you have the disclosure for June. You can see they delivered just under 25,000 units, and this was a nice increase of 17.5% year over year. So of course, they stated it, but then in July, they removed that part because it didn't look good, because they had actually sales decline. And for that reason, they only left the year-to-date increase, which looked good, at 25%. Because the year-on-year decline, I apologize, there was an increase of 3%, but it was too low to brag about it, and that's why they removed it. It was not a decline, I apologize. So it increased from 20,500 units to 21,000 units. So it was only a very, very modest increase. And that's why they left it out. But let's go back to the forecast. So you can see it down here. Again, forecast significantly ahead what was actually delivered. And the next couple of months, forecasted super strong months, which again would translate to 375,000 total unit sales for this year. But again, it's highly unachievable because as we just calculated, they would have to deliver over 60,000 units now per month. And either you believe in a at least double or tripling in monthly sales, or they cannot deliver it, or they cannot deliver even this forecast. Again, this forecast is significantly below the full year guidance. But let's move on and let's look at the financial ramifications. But one thing before we do so when I made this forecast, this is all model bottom up. Here you can see the sales trends for NIO's various models on the market. At that point in time, NIO just launched 2 new vehicles, expanded the Onvo brand, which in China is called Ledao. So this is the label here, Ledao is Onvo. And this includes now a larger version, L90, not only the L60. But let's just look at these sales trends. So you can see that the NIO branded vehicles, they all saw a negative sales trend. So the ES6 trended down, the ET5 recently trended down, ET5 trended down. So all these vehicles trended down, and the loss in unit sales from the NIO brand was compensated by launching these new brands. First of all, the Onvo brand. You see this in these dashed lines, also by a product line extension. The ET9 was launched. So all these new products help to cover up the loss in the lineup, whatever the weakening in the lineup. But let's move on. Let's talk about money. And first of all, we need to talk about gross margin. So here you can see, first of all, the total gross margin in green, then the gross margin NIO earns in this blue or teal color at the top, and then this in this light blue color or turquoise color, the other sales margin. All these numbers are in percent, and what you can see is that in the most recently reported quarter, first quarter of 2025, NIO's total gross margin was a rather disappointing 7.6%, which was part of the reason why the stock sold off hard, but was in fact improving in the auto segment. Auto segment improved to 10.2%, was up from 9.2% the prior year. But important, so this is ancient history now, so we need to be forward looking. So when you look at the forecast actually reflects quite significant increase and actually all-time high margins for NIO in the second quarter that is about to be reported, and then yet another all-time high in terms of gross margin in the third quarter, and then a similar strong margin in the fourth quarter. The reason why you see this margin profile, the assumptions behind it is I anticipated various new product launches, and typically new product launches, NIO can sell higher trim versions of these products before they unlock lower trim versions that come at a lower selling price and therefore lower margin. But I don't even want to go too much into the detail. I spent a enormous amount of time modeling this. For you, what's important is to focus on the outcomes, and the key outcome here is that the forecast reflects significantly improving margins. That's the key takeaway across both segments, not only auto segment but also the other segment. And when you look at the full year totals, I expect a margin improvement for the full year of 12.5% for the entire business, and then going to 15.2% next year. And you can see that when you compare to 2024, there would be a massive improvement. Even though the Chinese market has not changed, the Chinese market remains very, very competitive. But before we move on, let's compare NIO, how this compares to the global automotive landscape. Here you see the total gross margins of not only automotive but for the entire business of some key players. So BYD is significantly higher, 20.1%. Even companies like Nissan, significantly higher. SAIC, which is basically the kind of the GM of China, meaningfully higher. NIO only at 7.6%. It's latest reported. Only Stellantis is low, but Stellantis is right now in deep trouble. And XPeng, which is not valued that much higher than NIO right now, has more than double, or reported more than double the margin of NIO. But XPeng also sells at significantly higher volumes, and we can quickly check that if we go back to this trailing 12-month sales trend analysis of key competitors. You can see whereas XPeng, so XPeng is in this, let's call it gold color or amber color. XPeng sold over the last 12 weeks almost 90,000 vehicles. That's significantly ahead of the 66,000 vehicles NIO sells. And importantly, these sales were generated with a smaller product portfolio footprint. I'd like to also add that XPeng in international markets outside of China has been a lot more successful than NIO, even in markets where XPeng launched much later. In other words, had much less time to do brand building. Additionally, what is very important when you compare XPeng and NIO, which are probably the closest peers in the Chinese market, XPeng has this huge bonus from its agreement with VW Group. XPeng receives a very high gross margin revenue by providing R&D services to VW Group. So XPeng should not only receive a premium over NIO in terms of overall sales, margin success and growth, etc., but also by having this significant VW Group bonus. And that was actually a major driver. And you can see this here, why XPeng delivered a 15.6% gross margin. The auto margin is significantly lower than it. So the bottom line is, the key insight here is that you should not be looking at NIO 7.6% margin, XPeng 0.00. NIO can easily get to XPeng, it just needs to scale. No, NIO also needs like a high gross margin revenue stream like XPeng to get there. So the key insight is that NIO, as long as it doesn't have a partner like VW Group, it becomes very hard or probably unachievable to get to this margin at the same scale XPeng is right now. And as we just looked at, XPeng is nearly 50% larger in terms of volume. XPeng is also not a company that is selling cheap products. XPeng sells in similar price bracket as NIO. So it's not a case that XPeng sells a lot more volume because they sell super cheap vehicles. No, they sell at comparable price points, which makes them the best peers. But let's move on. So now you see a gross profit. So you saw this unrealistic revenue projection. You saw this highly aggressive gross margin improvement, and the net result of that is what you see in front of you. So I expect on this highly optimistic outlook 250 million gross profit for the second quarter, over 400 million in the third quarter, and 550 million in the fourth quarter. So quite substantial improvements, but again, this is based on these highly optimistic and likely unachievable numbers. This next slide I will not spend too much time on. Please pause a look at it if you like. This shows you the underlying volume and average selling price assumptions by brand for NIO. And the key takeaway here is that the forecast still reflects NIO being the main volume seller, which we already can see in the trend will not be the case. And the reason why this is important is NIO has a much higher average selling price as a more premium brand than Onvo, and also as the low-end entry Firefly, of course, which yet again makes the gross margin improvement even more unrealistic. Next, we need to look at operating expense, because gross profit is not profit that matters to a company, because you can have great gross profit, but you can still go bankrupt if you have too many other expenses. So we need to look down the income statement, and the next category we need to look at is operating expenses. Operating expenses comprise R&D expenses, selling, general and administrative expenses, or short SG&A, and certain other items which are typically not that important. And you can see the breakdown of these numbers in front of you. So you can see here in this teal color, significantly over half of NIO's OPEX was spent on R&D expenses. So NIO, because the competition is brutal in China, on an ongoing basis has to spend a lot on R&D. However, it did come down a little bit. It rounds to zero, but there was a slight year-on-year decrease in overall expenses. But that was not driven, this is also another key insight. Operating expenses came down, or I expect to come down in the second quarter by 3%. They were up 25% in the first quarter, but the forecast reflects a significant reduction in the third quarter and another significant year-on-year reduction in the fourth quarter. So that's another key point to take away. So the gross profit is based on highly optimistic revenue assumptions, on highly optimistic margin assumptions, and the operating expenses are also based on highly optimistic reductions. Because keep in mind, the business is growing significantly, but the forecast reflects actually reducing spend. And this becomes very clear when we look at this chart. This chart expresses operating expenses as a percent of revenue. And the forecast has these high revenue growth rates, but expects shrinking OPEX. And therefore, the resulting ratio when we split operating expenses and R&D expenses and SG&A expenses is significantly decreasing for both. So for instance, in Q1, but Q1 is always seasonally high because the week's first quarter auto sales. So we shouldn't compare to that one. So we should look at the second quarter of last year. So NIO spent 21.5% of revenue on R&D and 18.4% on SG&A. And the forecast reflects a significant reduction as we go into the second half of 2025. And the reason is that I have not yet included the significant reduction, or we don't see the ratio to come down in the second quarter a lot. Is because we had this massive surge recently in R&D expenses and SG&A, and I don't think it's reasonable to assume that NIO can bring these items down sequentially by that much, especially given they just launched or prepared launch of new vehicles. So then when we look at the net result, so the net result of all of this, so gross profit less operating expenses is operating profit, and in NIO's case that is operating loss, of course, because the operating expense is just too large relative to gross profit, because the gross margin is still too low. And this is what we see in this chart. So in the first quarter of this year, NIO reported a loss of 879 million. I expect, based on all these highly optimistic assumptions, gross loss will come down to 663 million, and then in Q3 will come down further to 401 million in losses. Again, this is based on these sales numbers, which we I think already know are unachievable, and therefore the revenue is unachievable. And achieving the significant gross margin improvement that are reflected in these numbers also appear highly unachievable, and the OPEX base is also a huge question mark whether NIO can deliver on that. So this improvement that you see in this trend, very important to keep in mind, is really based on assumptions that are really far out. But still, and that's the key point, but still, despite this optimism, there's still significant losses. And then in the first quarter, you have this massive spike in losses because NIO has, outside of China, almost no needle-moving sales. And due to tariffs in Europe, tariffs in the United States, that's unlikely to change enough to make a needle-moving impact. And that's why the first quarter China seasonality in particular is very strong. And this is what you see reflected here in this operating profit drop, because we always see a loss in sales in the first quarter. And then you see a recovery, again, based on highly optimistic assumptions. But the key takeaway is, even based on all this optimism, NIO is basically for the rest of this year and next year for sure operating loss-making. And this is before we see further changes to the competitive landscape in China. The big one is Xiaomi making a bigger impact on ramping up its highly popular SUV product, and of course extending further its product lineup. And then there's obviously the number 2 in the market, Tesla. Tesla just expanded its lineup with the Model Y L. And then there is an unpredictable risk to NIO from Tesla actually delivering a, let me call it, nap function. FSD gets in China to a level where you can nap in the car. This would disrupt the marketplace. And NIO has nothing that is even close to that level. Plus, then obviously all the much bigger players. And let's go quick to this chart real quick to name them. So one is Leapmotor, very strong, impressive sales trend, still intact. Aito, owned by Huawei and Ceres Group, also very strong sales trend, recently slightly flattening. Xpeng just launched some vehicles that were very well received, and there's more coming just in a few months. Then there's Xiaomi. It looks like flat right now, but this is before the U7 is scaling, so I expect this trend to very soon pick up. And then there is obviously Geely, which is about to push into the market with next generation platforms. So the Chinese market remains extremely competitive, and all these companies that you see here, they all have a lot more financial firepower, much larger scale, and NIO is actually the smallest players amongst them. If you look at, say, 66,000 sales, you might be saying, oh well, but it's larger than Zeekr. But keep in mind, Zeekr is only a subsidiary owned or controlled by Geely. So Zeekr benefits from all the power of a much larger vehicle seller. Geely is actually number 3 globally in electric vehicle sales, just behind Tesla and now before VW Group. But let's move on in the forecast. So in terms of operating margin, so what's the outcome? So last quarter, the operating margin was a shocking 53.3% reported. I expect an improvement to negative 31.1%. Third quarter, negative 12.7%. Fourth quarter, just under negative, or above, I should say, 12% negative at 11.8%. But then operating margin, of course, as we saw in prior numbers, will continue to be negative. And then, so then the bigger question is this company, given it's really just an automotive company, worth the current market cap? And what you have to keep in mind is the current market cap is understated, because we do know, and even the greatest NIO bulls will not deny this, the company is still burning enormous amounts of cash, and for that reason they will have to raise more capital, and this will dilute shareholders. So in order to deliver this extremely lofty outlook that you're looking at, that's still negative, this will be based on a larger number of shares. That's why when you look at today's share price and you look at the implied market value, the actual market cap based on today's share price to deliver this outlook is actually a lot more, because the capital raise necessitates that you have a larger share count. So I estimate NIO trades right now not too far away from $20 billion after everything is said and done, effectively, all the dilutive instruments, etc., all the capital raises necessary to get it to a level where it's self-funding. And when you look at around the global landscape, there are a few automakers that are valued significantly more than that. So you're really betting many years into the future for not that much of upside. And that's why I argue given all the optimism built in its outlook, and it's still so negative, NIO is right now in a significant bubble. This is not the first time. NIO has been in a bubble multiple times before and significantly burned investors. But let's look at kind of sort of the future end state. So here you see the auto industry. You see NIO's operating margin, and it again, this is latest reported, and then you see also NIO's projected operating margin for the end of next year based on this highly optimistic outlook. So that's a negative 3.2%. There would be a massive improvement from the latest reported negative 53%. But when you look at the global auto landscape, the auto business is just a really bad business, and you can see this by all these very low operating margins. So even the end state looks very unattractive long term. And for example, you can see Nissan 0.2%, Ford 0.8% operating margin, Honda 1.4% operating margin, Tesla 2.1% operating margin, General Motors 7.6% operating margin, Hyundai, it's a huge company. It's not only, anyways, they have huge benefits, but even they only 8.2%. BYD 3.3% operating margin, even though this also includes the quite successful batteries business. This shows you the cutthroat nature of the Chinese market. Even the biggest players in certain segments suffer from very low margins. Toyota, huge machines selling at all-time high volumes, also only 9% operating margin. BMW, premium seller, very established, 9.3% operating margin. Kia, part of the Hyundai group, also a lot of benefits. Despite those benefits, only 10.7% operating margin. VW group, that has the Porsche brand, high margin Porsche brand, also Audi, etc., also only gets to 3.7%. So the auto industry, you cannot coin it any other way, it just sucks. So this is sort of what NIO future looks like, kind of. But for completeness, we need to move on in the forecast. So there's non-operating items which are also forecast in a positive way. There were non-cash fluctuations. They're not important, but I'm just showing you this, what's flowing through the forecast, not a needle mover. Then we get to the profit before tax, again, super negative. Then we look at a profit margin similar to the operating margin, very negative. Tax expenses that flows to the forecast, I just showed this for completeness. They are de minimis because, again, forecast projects losses, so there's very little tax expense. Then we got to shareholders' net income, super negative. So, and because NIO is still in for the next 2 years super loss making, this is why it's very hard to do any kind of multiple valuation. And for example, PE ratio doesn't work at all. And the DCF approach, a discounted cash flow model, requires way too many assumptions. And even things like EBITDA, once you get into the detail, enterprise value to EBITDA multiple is quite tricky to do in NIO's case. So right now, investors are just betting on some high volatility. Then let's look at cash flow. So this is historic cash flow of NIO, and you can see sometimes also called burn rate, because how much capital they are losing per quarter. You can see in the fourth quarter it was 756 million. So this is cash flow defined as operating cash flow less capital expenditures, because NIO's lofty volume growth also requires, once they hit the maximum capacity, additional capital investments. And because NIO is similar to NIO, constantly has to kind of improve their production lines to generate better profitability. I will not dive into how this works here in this video, but the bottom line is they have a very high ongoing burn rate. And the fact that NIO actually killed quarterly cash flow disclosure is a huge red flag. So what you see here is based on disclosed annual cash flow data, but we cannot do this anymore on a quarterly basis. I expect first quarter cash burn was quite high. And then the other problem is that NIO is quickly running out of how much off-balance sheet funding it can squeeze out of suppliers, and this is what this analysis shows you. It shows you days payable outstanding, which is a metric that calculates approximately how long it takes until NIO pays suppliers. And you can see NIO was in Q1 at 266 days. There's some seasonal factors why it spiked up so much. But even on the most recent low, which was in the second quarter of 2024, NIO was still significantly above 100 days and also significantly higher than most competitors. BYD, which is paying significantly faster than NIO suppliers, recently got under quite a bit of heat as the supplier voices grow louder, complaining about this practice. So what's the bottom line of all of this? And I think it's good to look at this chart again. This shows shareholders' net income. Anyone who buys the stock is looking, even under a highly optimistic scenario, significant volume growth, significant margin improvements, OPEX under control, years of losses, and even long-term the outlook for NIO as an automaker is not that attractive, because NIO plays in a market that has always been affected by various factors that have to do with employment, geopolitics even. We can see this in Europe with tariffs and United States. Just an attractive business, and that's why I think NIO is, and given the cutthroat nature of the Chinese market, it's by far most important market, makes NIO, I believe, a highly overvalued stock right now, since the stock is quickly approaching effective 20 billion market cap. But let's look how I, as a forecaster, how I have done. So this video will be posted as part of as a post that I will label as investor warning. I only send investor warnings when there's like a very crazy case of something being completely overvalued. And here you see X Pro, and I've been searching my profile for investor warning, and the first one that comes up is Rivian, which I sent on May 3rd. Rivian stock rallied like crazy. You can see here Rivian stock was at $14 per share at the time. Rivian kept rising further, briefly touched 17 and then dropped down to below $12. So I completely nailed it. Timing was not perfect, of course, but timing is 100% exact timing is an illusion. You only hit them when it's a fluke. But this call was correct. Then when we look at what's the next investor warning that comes up here on X, what's this? I know this is just a random post. Here's another random post. So this is like a proper investor warning I sent out. So this was Polestar. I sent this in August 29. Stock later collapsed. This call was also 100% correct. Here I'm just bragging a little bit about this correct call. Here's another investor warning about Volkswagen and Rivian, sent out in June 26th. Rivian stock rallied 55% on the announcement to, I think, touch briefly $18 in after hours trading, and then lost everything. Traded below, I think, $9 even at one point. So any investor who listened to me sold the stock. I saved them from huge losses. Here, I'm warning about Rivian downside case. This was in relation to the same post. I warned on June 5th. So all this nailed it. You can go back and check the share price, how it developed. Here, Polestar warning. EVgo I warned. EVgo later collapsed, was 100% nailed this. Here's Polestar. Again, this was crazy overinflated stock, completely nailed that one. Let's see, what else did I post? Here, Lucid, October 17th, also nailed that one. Lucid stock subsequently collapsed. So basically the bottom line, why I'm showing you this is, first of all, when you look at investor warnings, actually not that many posts come up. This is number one observation. I don't make them often. And all investor warnings I did publish, they all nailed it, but in a big way. And this is not because, you might think, maybe HA deleted post. Check. No, I don't delete these posts. I hardly ever delete posts. I only delete posts when there was like a numerical, it was like a typo or something. But I deleted maybe, 5-6 posts amongst the over 40,000 I posted. Because usually and again, these typos are not like predictions, wrong prediction, I leave them there. It's just when I say, this is 1 billion, in reality it was 1 million, because just a typo. But long story short, all my investor warnings, they totally nailed it. So today is one of these rare investor warnings I publish. And based on my track record, and based on what I presented to you, you might want to consider my words over the hype that you see everywhere else. With that, thank you very much for listening. See you next one. Bye.